Boom. Job and income. So
That is
before
nifty.
we, before we get into job and income, and I should have done this at the beginning of each segment. Okay, so this is either first-time homeowners or not first-time homeowners. If you are looking to buy another house or get into your first house, where you need to start is Michael. You need to start at the mortgage level. Don't go looking at houses before you find out what the best house is for you. What the parameters, there you go, what the parameters are. Wow, better do a smaller circle. What the parameters are for that house. It's never about the house, people. It's about the parameters for that house and your long-term goals, so that you put yourself in a great financial position, because odds are you're not going to stay in that house. And you want that to be a blessing to you and your family. So start there, get somebody because I won't start. I will not go show somebody houses until I sit down and find out what their goals are. There's plenty of agents there. Trust me, there's a plethora of agents out there that would love to take your money, right, and go show you houses and not have a goal. Nope, that's not what I do. That's not what Michael would do. Let's come up with a plan. And it's not like you're going to have to do everything and come up and jump through all these hoops. Just a couple of hoops up front so that you can get that letter, and he'll talk about that at a different time. And so you know kind of where you're at, so you don't fall in love with a property that isn't going to help you. And I apologize for that. I should have done that right up front. That really should have been the very first thing that I said, because I'm speaking from experience, right? I didn't do it right one time, and it's hard. So job and income. You know what, Michael, I keep hearing that I got to be in my job for 2 years. Really? I'm moving into town, or I just started a new career, or I just graduated college. You mean you tell me I can't get a job? I mean, I can't get a house? That's my softball.
Yeah, I got it. I caught this one. I was ready for it. No, you do not have to be in your job for 2 years, with an asterisk. So maybe two asterisks. So you have to have a 2-year work history. Yeah, there's some variables even to that. So if somebody goes to school and they're going to be a doctor, so they get a degree to be a doctor, they get a doctorate, and they come out into the workforce, they've been a doctor for 2 months. Well, clearly you don't have 2-year work history, but in that case, we can actually give you credit for your schooling as part of your employment history. As long as whatever you came out and did for employment, you were in school for, we can connect those dots and give you 2 years there. But for someone who's been working, say 10 years, they switched their job 6 months ago, and now, again, their salary, doing whatever, doesn't matter. You're fine. That's okay. What they're concerned about was there a gap of unemployment between the last job and this job? If you were out of work for 6 months because you decided you wanted to sit on the couch and eat Cheetos and play video games, that's a concern, again, from a lending standpoint, right? Because we're thinking we're about to give you a couple $100,000 and you found it more important to sit on the couch and play Call of Duty. That doesn't make us feel warm and fuzzy, right? So those situations lead to a lot more questions and letters of explanation explaining what happened. Now, if you had medical issues, if the company you worked for folded shop and you had nothing to do with that, you were laid off out of your own will, that's okay. Those are reasons, again, extenuating circumstances where we're fine. But you do not have to be on your job for 2 years. It does help if you're going to switch jobs in the coming future. It's in the same line of work. That's an important factor, especially if you're an hourly employee, because they want to make sure that workload is going to be stable, that you've had experience with that. But salary makes things a little bit easier in terms of that. Now, if you are looking at using income from things like commission, commission generally requires a 2-year history. It requires a 2-year history almost entirely. It's a 2-year history, but there's ways to again, kind of skirt's not the right word, but piece it together. So for instance, I'm in mortgages, right? I am paid a commission on a transaction. You're a realtor, you're paid a commission. If you, for instance, David, leave your brokerage today and go to another one tomorrow, but you've been making commissions for the last 2 years at your current brokerage, I can actually piece together that history because you're doing the exact same thing. You're making the exact same type of commission, and we're good to go. But if, David, you were a teacher today and tomorrow you become a real estate agent and you're making commission for the first time in your recent history, that is no longer income that I can use for you.
Mm-hmm.
Okay?
Yep.
Same thing with bonuses. It's important to have that history. But overall, for our W-2 employees, for our hourly employees, you absolutely do not have to be on your job for 2 years. That's not a requirement.
So let's talk about that real life situation that came up, what was it, 2 weeks ago? Say, and I'm talking right to the people again. So say you're moving to a new area, you're relocating, or you're just getting ready to get a job. You need to have what's it called? The offer letter. The offer letter. Because once again, it makes sense. The more I talk to you, you really do a good job about putting it at a level to where it's about the risk. And the people that are going to lend you the money want to say, oh, yeah, I got a job. Okay. Or I'm going to get a job. Great. Show me the proof. And it's not because they're being mean. Once again, they have to show in a stack of papers why you're a good risk. That's it.
Right.
So remember that, because we just went through this and I learned something. I didn't know that. So if you're relocating, and because this young lady, she's moving up from the hill country, and she didn't have her offer letter yet. Well, we didn't need to look at houses yet, because until she gets that offer letter, guess what? She's going to find a house, and they'd already found a house that they were looking to put an offer on. All that's going to do is break your heart. We don't want to do that. So you have to have someone that's been around a while and has, well, either has some gray hair or is losing it. That can,
or losing it, yes, thank you.
Yeah, or exactly. That can guide you through and kind of say, hey, give you some seasoned advice, put it that way. Nobody's going to treat you like a child, but at the same time, some good advice to say, hey, well, let's slow down a little bit. Let's go this direction from experience. Let's talk to this person. So this is really good here. So the factors because everybody talks about these factors on how much, you're going to get a loan for X, but it's like a mystery. Well, how in the world do they come up with this? What do they look at to say this is how much money that you're eligible to get because of X, Y, and Z? But nobody knows what X, Y, and Z is. At least the common public doesn't. Debt to income ratio and things like that nature. But so what are those factors? Try to, treat me, not them, but treat me like I'm two. Should be pretty easy.
So, well, so I want to touch on the transfer thing. There's a couple different types of transfers, right? So there's the, hey, my company, I'm going to be within the same company and basically doing the same thing and going to be just transferred to new location from Colorado to Texas. That happens. That's actually super easy. We just need something from HR stating, hey, they're going to be transferred. Here's your income, and we're all good. If they're going to be starting a new position, then yes, that offer letter is very important. But you don't actually have to start employment. We can qualify you solely on that offer letter. You do have to start within a period of time. Depending on which program we go with, those rules are different. It could be 30 days, can be 90 days, but you don't have to wait until you start. So pretty cool feature. Again, there's some things that we'll talk about in those situations. Now, from a debt to income ratio standpoint, it's actually a pretty easy thing for just our consumers to do on their own. But what we're looking at here is we're not looking at things like your insurance, your car insurance, I should be clear. We're not looking at things like your health insurance. We're not looking at your cable bill, your cell phone bill. Those are not things that are factored into the overall debt to income ratio. What we are looking at are things that report to the credit. So that is your student loans, your personal loans, credit cards, car loans. You have a mortgage already. Those are all debts that are going to show me a monthly payment on the credit report. That is what I have to factor in. Okay. And now, if you're going to be opening up new debts as well, by the way, tell your lender that. That's important information, because if you think that we're in the middle of the process, we're good, or we already pulled credit, we're good, that will bite you. So if you're going to open up a new debt, which is a sin during the mortgage process, let us know. But you take your total monthly payments. You don't really care about the balances that you have. You take the minimum monthly payments. And again, I say minimum. If you make extra payments, that's wonderful. Good for you. Don't care. Don't need it. So just minimum monthly payment. And we're going to add those up. And we're going to divide that by your monthly gross income. A lot of people who fill out applications give me their net take home, which I understand why they would give me that. And almost logically, that makes more sense.
Yep, it does. Yep.
Right. But we do the gross because there are, when we look at it from the lender side, we have debt to income ratio percentage guidelines. So it says basically if your debt to income ratio is above a certain number, let's call it 50%, then you can't qualify. So that other 50% that is available is really factoring in that you're going to have taxes, you're going to have insurance, you're going to have life things going on. So that's why we do gross. That's why we don't care about your car insurance, because it's already essentially built into what that guideline is providing us. So anyway, you take your monthly minimum payments on debt plus a new hypothetical mortgage payment, whatever number that is that we discussed, you're thinking you can afford in your budget, and divide it by your monthly gross income. And that is how you calculate your debt to income ratio percentage. Now, depending on the program that we go with, that guideline, the max you can have changes. As a general rule of thumb, try to be under 50%. 50% is very high. I should be clear. That's very high. But from a loan qualifying standpoint, if you're under 50%, you usually have some multiple options that we can work with. Now, again, it's relative, depends on what your credit score is, what you have available for down payment. You can even push it that high. But if you know you're above that, then we need to work on that. We absolutely need to start paying off some debts and things like that. But my suggestion is before you even do go and pay off debts, is still have that conversation with me, because a lot of people, even from like a credit repair standpoint or them trying to improve their own credit, they say, hey, I'm going to pay off XYZ. Well, sometimes paying off those debts, other than a debt to income ratio standpoint, they don't actually help you. Or we can better allocate that money elsewhere. So have that conversation with me and let's come up with a strategy together to really make this the most efficient process from a debt to income ratio and credit standpoint that we can.
Yeah, and then definitely don't close out that line because that hurts you.
Correct.
Well, that was a great point that I learned not too long ago about closing out a line, because I didn't, we were able to pay off some things and I just wanted to get rid of it. That's not really good. If it's good to get it's good to get it paid off, right? Because you don't want to be paying interest. Cash is always king. But at the same time, to close that line out, that credit line out, is not going to help you. So we're going to transition here. Oh, before we do that, so job and income. Man, there's so many things that he talked about there. The biggest thing would be there's options. Once again, if you think about it, of spreading of risk, there just needs to be something that you can show and prove that you're a viable risk. That's it. And how to do that, there's programs, there's different things in place, but just go through the process with somebody you trust. I feel like a broken record here, but that's going to be the key, because it's kind of like playing ball. I mean, he who knows the rules wins. That's it. And if you know the rules, you can best position yourself to win. There's nothing wrong with knowing the rules and helping your team out, which is you, right, to win. And that's what they do, correct? I mean, you figure out how to help your clients win. That's it, within the rules. Don't play outside the rules. I do want to visit about the one before we go into closing. I've got one young man that he's not ready and he's concerned, and that's okay. He's about the market. He's not for sure whether this is the right time. He has a great job, and they've got the money and he's got money saved up, but he wants to wait. Then wait. Don't do anything. I'm not of the mind, because I grew up as a realtor's son, of you are not throwing your money away by renting. You are not throwing your money away by staying in an apartment. No. Are there some things that could help you long term if you get into something that is helping you make money? Not literally, but figuratively, because you can put money into it and you sell it, right? You'll make money off of it. Sure. But if you're not ready, don't do it. Now, do not stay away from doing something because you're fearful. That's different. because now you're in an emotional state. Try to be and this is a book, but try to be in the adult, if that makes sense. Not in the child. The child in you and that emotion, or basically that is the emotion side of you, and you make decisions on what's best for you emotionally, makes you feel good. That's not the adult. The adult in you takes the facts, looks at it and says, this is what makes sense because of here's the factors and here's the best probable result from that. I say all that to say, just talk to somebody that you know, talk to somebody that's knowledgeable, get somebody on the phone or meet them in person like Michael or myself and listen and see whether the words that they use and the questions they ask, are they truly there to help educate you and talk to you, or are they just trying to talk over you so that you'll get out of their office and they can make money off of it? We know these people. You know, it's the world we live in, but it's okay because that actually helps us. It's sad that customer service is very poor and most people don't take care of people because that should be, average should be that standard, but we don't. This average is pretty sad these days. What do I want to leave you with? Michael DeBacco. Great guy. I wouldn't have him on, people. I've told you this before. I've had other mortgage people on, right? I am going to bring you people that have the heart of a teacher, that are there to help, and they care to do what's right for the right reasons above all else. Because business will come, money will come. It's really not that hard if you're willing to work hard. The working hard is what most people don't want to do. We're here to help you. Call me. Michael, what's your website? Where can they, how can they
so a couple spots. Facebook at The Mortgage Mike, all just common spellings. Get me on there. Website www.mortgagemike. Again, common spelling. Mike is short for Michael, M-I-K-E. So mortgagemike.us, as in United States. No com, no net, no nothing. So mortgagemike.us. And of course, cell phone, guys, you can literally text me. I don't care. Text, call, reach out to me at 214-718-2248. 214-718-2248.
Yeah, I caught him in a pig blind 3 weeks ago. He really will pick up. Try to respect his time, though. From me to you, people, if you don't get anything out of this today, remember two things. Number one, God loves you. Number two, I do as well. If you get the first one right and understand that, it'll carry you through so many things that you don't understand. All right. I hope you found this enjoyable. I hope you found this informative, and to see that we're really here to help. If you do, hit the subscribe button, ring the bell so you can find more stuff that comes out quickly. And then for the next video, right, just click up there. Michael, I can't tell you how much I appreciate you being on with me today. Hold tight, because I'd like to visit with you after this is over. But thank you so much, my friend. I appreciate you coming on board.
Thanks for having me, buddy. Appreciate it.
You betcha. Y'all have a blessed day.